Hey everyone, welcome back. This week felt like the market finally took a deep breath, then immediately paused to see if the air was actually safe to breathe. We were talking about the inflation surprise, the shifting rate narrative, and why one single data point managed to move stocks, bonds, and expectations all at once. So let us start with the biggest catalyst of the week, the US inflation report. On December 18, the CPI data landed and instantly changed the tone across markets. Headline inflation slowed more than expected, coming in at 2.7% year over year, reinforcing the idea that disinflation is still intact rather than stalling out. Core inflation, which strips out food and energy, also continued its gradual cooling trend, staying well below the peaks seen earlier in the cycle. That year-over-year picture matters because it is what central banks care about most when they think about longer-term policy direction. For investors, it strengthened the narrative that inflation is no longer the dominant upside risk it was a year ago. As soon as the numbers hit, equities reacted fast. Stocks snapped a losing streak, with the S&P 500 jumping roughly 1%, the Nasdaq climbing around 1.4%, and Treasury yields sliding as rate cut expectations were pulled slightly forward. In classic fashion, risk assets rallied first, and questions came later. But to really understand why the market reacted the way it did, you have to look beyond the headline number and zoom into the shorter-term momentum inside the inflation data. This is where the month-over-month readings come in, because they show whether price pressures are accelerating or fading right now, not just compared to a year ago. On a monthly basis, both headline CPI and core CPI showed more restrained price increases, reinforcing the idea that inflation pressures are cooling rather than re-accelerating. That helped calm fears that the Federal Reserve might need to keep rates higher for longer than currently expected. However, here is the critical nuance that kept markets from fully celebrating. Parts of the inflation data collection process had been disrupted earlier in the fall during the government shutdown period, and that immediately raised questions about data quality. So while the numbers looked friendly, traders also knew this print might not be perfectly clean. That uncertainty explains why the rally felt more like relief than confidence. Yes, inflation came in cooler. Yes, markets bounced hard. But positioning stayed cautious, volatility remained suppressed, and investors treated the move as a temporary green light rather than a full policy pivot. So the big takeaway from this CPI report is simple but powerful. In thin late December trading, one inflation print can still move everything, but the market is no longer reacting with euphoria. It is reacting with cautious optimism, knowing that the disinflation story is alive, but not fully settled yet. Next up, Japan. Its central bank raised the policy rate by 25 basis points to 0.75%, the highest level in nearly 30 years. Long-term Japanese government bond yields pushed above 2%, the highest since the late 1990s, and that kept global rate markets on edge. Even after the hike, the yen weakened, a reminder that investors were weighing fiscal worries and the risk of more tightening ahead. Now, here is what matters. When Japan finally moves, it can ripple through global borrowing costs and leverage positioning, and that anxiety hung over the entire week. In the UK, inflation cooled sharply, and the Bank of England cut its policy rate to 3.75% on December 18. The decision was close, which told markets policymakers are still uneasy about lingering inflation pressures even as the economy looks stuck in low gear. But here is the key point. A cautious cut is not the same as an all-clear pivot, so expectations for the next move stayed jumpy. Across the euro area, the European Central Bank kept rates unchanged again, leaving the deposit rate at 2% for a fourth straight meeting. Policymakers sounded comfortable with where policy sits and signaled a wait-and-see approach rather than rushing toward more easing. So what does this mean for us? With one big central bank holding steady while others move, markets start trading divergence and cross-market spillovers, not just the direction of rates. Early in the week, the U.S. jobs data rekindled the slowdown debate. The prior month was revised to show a drop of 105,000 jobs, and the unemployment rate moved up to a four-year high. Federal payrolls were a major swing factor, making the headline feel noisier than usual after the shutdown disruption in the fall. Now, here is what matters. It kept the soft landing story alive, but it also kept recession fears close enough to trigger fast, emotional swings in both stocks and bonds. Now, zooming in on the broader market after the inflation-driven whiplash, the big question is simple. Did that relief rally actually repair the chart? On this SPY chart, which tracks the S&P 500, price has been trading below its rising trend channel for 6 straight sessions, about 1% under the lower boundary. But here is the key point. That lower band is no longer support. It is acting as resistance, and that is exactly the kind of subtle damage that keeps a cautious, jittery tone in the market. The channel itself is still strong, rated 7 out of 10, and since March 17, 2025, price has stayed inside it for about 70% of the last 24 sessions, which tells you the uptrend has been the default regime. There have also been multiple significant breakout events in this regime, including moves on March 28, 2025, April 3, 2025, and May 5th, 2025, so clean breaks have happened before and traders remember how quickly they can accelerate. Now, here is what matters for next week. Daily ATR is only about 30% of the channel width, so the structure is tight and getting back above that lower band may require a bigger than usual daily range to force the issue. That is why the mood is not euphoric, it is careful relief, with buyers trying to reclaim the trend while everyone watches for the next shove that could wake the tape up. This ties back to the damage we just saw in the daily chart and zooms into the shorter-term battlefield. On this 4-hour SPY chart, which tracks the S&P 500, a clear upside impulse has already been detected, running from roughly 650.85 up to 680.74, and price is still moving inside that A to B leg. That sets up a classic situation where a reflex pullback into the Fibonacci retracement zone between 38.2 and 61.8% becomes statistically likely rather than a straight line higher. So, the market is basically saying momentum exists, but patience matters, with the next shallow retracement around 673.69 sitting very close and deeper levels down near 669 and 665 acting as the real decision zone. The preferred bias here stays short on rallies within the broader trend, while counter-trend bounces are possible but need tight risk control. That fits perfectly with the mood of the week, cautious optimism on the surface, but traders clearly planning for controlled pullbacks instead of chasing highs blindly. At the same time, tech is quietly answering the question everyone is asking after that pullback. On this QQQ chart, which tracks the Nasdaq 100, the golden cross is still very much alive, with the 50-day moving average above the 200-day for 126 days and both still rising. Price briefly dipped below the 50-day for 4 sessions, shook out weak hands, and then buyers stepped right back in, pushing it back above both key averages. So that move matters because it tells us this was a correction inside a bullish trend, not a trend break, even as the broader market stayed tense and selective. With easing rate pressure and cooling inflation expectations in the background, growth stocks found just enough confidence to defend structure without triggering full-blown euphoria. Meanwhile, this is where the confidence from the Golden Cross gets stress tested. On this QQQ chart, tracking the Nasdaq 100, price has been trading below its rising trend channel for 6 sessions, sitting roughly 1.5% under the lower boundary. That lower band has flipped into resistance, which explains why upside attempts have looked hesitant instead of explosive. So, even though the broader uptrend is still intact, with about 70% of recent sessions holding inside the channel since early spring, momentum is clearly cooling and traders are respecting levels. With a moderate channel quality and a balanced daily range relative to the channel width, this is not panic territory. But it is a zone where patience beats aggression as the market decides whether tech can reclaim leadership or needs more time to digest gains. Shifting gears to the more defensive side of the market, the Dow is quietly sending a warning flare. On this DIA chart, which tracks the Dow Jones Industrial Average, price pushed to a higher high while RSI printed a lower high, creating a clear bearish divergence that often precedes at least a pause or pullback. But here is the tension: the medium-term trend is still intact, with DIA closing above its 50-day moving average for 18 straight sessions and never actually closing below it despite one brief intraday dip. That tells you sellers are testing the waters, not fully taking control yet. In a week defined by cautious relief and thin confidence, this kind of divergence fits perfectly, strength on the surface, but cracks forming underneath that keep traders alert rather than aggressive. Finally, small caps are the last piece of this puzzle, and they explain why confidence still feels fragile. On this IWM chart, tracking the Russell 2000, price has been trading below its rising trend channel for 4 sessions, sitting just under 1% beneath the lower boundary. That lower band is acting as resistance, and volume has been picking up as price presses closer to it, which tells you participation is rising, but direction is still undecided. The broader trend is not broken, with over 70% of sessions holding inside the channel since early spring, yet the structure is tight and daily range is relatively compressed. In a week marked by relief mixed with hesitation, small caps lagging like this reinforce the idea that the market is selective, cautious, and still waiting for a clear green light before committing to a full risk-on sprint. Switching over to crypto, this is where the risk appetite story starts to wobble. On this BTC USD chart representing Bitcoin, the market remains locked in an extended death cross, with the 50-day moving average below the 200-day for over a month and both still sloping lower. Price is trading nearly 19% under the 200-day, which confirms the broader downtrend, but also shows how stretched the downside move has become. That stretch explains why selling pressure has slowed without flipping the trend, as traders wait for confirmation rather than forcing fresh shorts. In a week where equities showed cautious relief, Bitcoin failing to confirm that optimism highlights lingering nervousness and reminds everyone that not all risk assets are buying into the calm just yet. Now zooming in, the Bitcoin chart tells a very different story beneath the surface noise. On BTC USD, Bitcoin priced in US dollars, volatility has been compressed for 15 straight sessions with the TTM squeeze clearly on, signaling pressure building rather than releasing. The short-term bias still leans bearish. But here is the twist. Buyers stepped in late, with price closing in the upper quarter of the daily range, and momentum indicators flashed a short-term buy as the stochastic %K crossed above %D from oversold territory. That combination captures the tension perfectly. Tight volatility, bearish structure, but aggressive dip buying creeping back in. It answers the key question from the prior scene. If Bitcoin is deeply stretched to the downside, the market is no longer selling blindly. It is waiting for confirmation before making the next big move. Meanwhile, this wider lens shows why the crypto market still feels heavy despite short-term sparks. On this BTC USD chart representing Bitcoin, price has only just slipped back inside a clearly defined falling trend channel, a regime that has held roughly 70% of the time since mid-year. The structure is strong, with the lower band respected just recently, and price sitting only about 1.5% above that floor. That creates an awkward imbalance with far more room overhead inside the channel than downside room below, even though the broader trend remains bearish. With daily range still tight relative to the channel width, it reinforces the same message as the squeeze: energy is building, nerves are tight, and any breakout will likely need a decisive expansion to break this uneasy calm. Turning to rates, this is where the calm under the surface really comes from. On this TNX chart, which tracks the US 10-year Treasury yield, the market is still sitting in a death cross, with the 50-day moving average below the 200-day for a long stretch. But the message is changing, because the 50-day is flattening while the 200-day keeps drifting lower, a classic sign that downside momentum is fading. That shift raises the risk of a sharper short covering rally in yields, something equity traders watch closely. In a week defined by cautious relief rather than fear, bonds stopped screaming trouble, and that subtle easing helped keep risk assets supported even as confidence stayed fragile. Another angle here shows why yields have quietly stopped cooperating with the bearish narrative. On this TNX chart, tracking the US 10-year Treasury yield, price has been trading above its falling trend channel for 11 straight sessions, sitting about 1.5% beyond the upper boundary. That former resistance has flipped into support, which is a meaningful change in behavior even though the broader channel quality remains moderate. With daily range still tight relative to the channel width, this breakout has not turned explosive, but it has been persistent. In the context of cautious relief across markets, this steady hold above the channel signals that rate pressure is no longer accelerating lower, keeping investors alert to the risk of a slow grind higher in yields. Stepping into currencies, this is the final piece connecting rates and risk sentiment. On this DXY chart, which tracks the US dollar index, the death cross has been in place for a long time, with the 50-day moving average below the 200-day for well over 100 sessions. But the character is changing, because the 50-day has already turned higher while the 200-day keeps drifting lower. That means the downtrend is no longer cleanly bearish, and the death cross itself is being actively tested. In a week marked by cautious relief across markets, a stabilizing dollar adds another layer of tension, hinting that macro cross-currents are shifting rather than collapsing in one clear direction. Meanwhile, the dollar is not crashing, it is quietly grinding in a controlled downtrend, and that matters for everything else. On this DXY chart, which tracks the US dollar index, price has been inside a falling trend channel for 18 sessions, and the channel quality is strong with repeated band touches. The range is extremely tight, with only about 0.8% room to the upside inside the channel and about 1.2% room to the downside, so the dollar is basically coiling. The upper band has been respected again and again, while the lower band has not been tested recently, keeping the move orderly instead of chaotic. With daily range still tight relative to the channel width, any real breakout likely needs a bigger than usual burst, and that fits the week's mood perfectly: cautious relief, but everyone bracing for the next macro shock to break the calm. Stepping over to commodities, oil is basically waving a red flag at the whole risk-on story. On this CLTF chart, which tracks WTI crude oil, the market is stuck in an extended death cross, with the 50-day moving average below the 200-day for 327 days, and both stay trending down. Price is also sitting roughly 10% below the 200-day, which confirms the bearish trend and shows how stretched the downside has become. But here is the key point: when oil stays this heavy, while stocks try to stabilize, it often reflects lingering demand anxiety and keeps traders from getting too comfortable. In a week of cautious relief, crude refusing to heal is a reminder that the macro backdrop still has weak spots that can bite if sentiment turns. Another layer here shows why oil weakness is not just noise, but part of a bigger pattern. On this CLTF chart tracking WTI crude oil, the latest drop of more than 10% carved out a deep drawdown of roughly 26% before finding a low, marking the 18th pullback of that size in the last 5 years. We are still in the early phase of recovery from that move, which historically is when price action can stay choppy and unreliable. So, the takeaway is that oil is not screaming immediate collapse, but it is also nowhere near healed, and another sharp drop from the current swing high would kick off a fresh red leg. In a week where markets leaned into cautious relief, this kind of fragile rebound in crude keeps a ceiling on optimism and reminds traders that global demand signals remain shaky. Finally, gold is telling a very different story than oil, and traders are paying attention. On this GLD chart, which tracks gold prices, the market has been riding inside a rising trend channel for 26 straight sessions, and the structure is rated strong. Price is sitting right near the upper boundary, less than 0.5% below it, showing persistent demand even as volatility across other assets stays muted. There is far more room below than above inside the channel, which means upside progress from here needs real momentum to avoid a sharp pullback. In a week defined by cautious relief and lingering macro tension, gold quietly holding strength acts like an insurance policy, signaling that investors are still hedging even while risk assets try to stay calm. Meanwhile, the volatility gauge is flashing a warning through its silence. On this VIX chart, which tracks expected volatility in the S&P 500, the index has stayed under 20 for 18 straight sessions, showing just how calm the market has become. Volatility is crushed, price swings are muted, and traders are clearly comfortable. But here is the uneasy part: prolonged calm often breeds complacency, not safety. In a week defined by cautious relief rather than conviction, a sleepy VIX suggests the market is relaxed enough that any surprise could hit harder than most are prepared for. Looking at the economic calendar, next week is extremely quiet, and that makes one release stand out. The only high-impact event is U.S. gross domestic product on Tuesday at 1003 p.m. Eastern. With volatility already compressed and markets leaning into calm, GDP carries extra weight. A strong number could push yields higher in test-risk assets, while a softer print would support the relief rally narrative. With nothing else to distract traders, this single data point has the potential to move everything, especially in thin conditions. Wrapping it all together, this week left the market walking a tightrope. Stocks stabilized, volatility stayed crushed, and macro pressure eased just enough to support prices, but the charts are full of hesitation signals. So, the setup going forward is not about chasing highs, it is about respecting levels and staying selective. In a mood defined by cautious relief, the market is balanced between patience and complacency, and that makes risk management the real edge as we head into the next stretch. To close this out, this is the moment to stay sharp and stay patient. The market feels calm, almost comfortable, but the charts show pressure building just beneath the surface. That meant for War's discipline, not impulsive trades. If you found this breakdown useful, stick around, because the next move often starts right when things feel the quietest.